The January Fed meeting is 3 weeks away, and the odds for a 25 basis point rate cut have stayed under 20%, currently hovering right above 16%. Now, the December Fed minutes showed how divided the central bank is, and officials also wanted to see more economic data before making their decision. 8 officials see 2 rate cuts this year, but 7 project no cuts at all. The December jobs report coming out on Friday morning could impact the chances for a rate cut. Well, joining me is Mike Goosay, CIO and Global Head of Fixed Income for Principal Asset Management. Good morning, Michael. Great to have you here.
Thank you very much. Happy New Year.
Happy New Year. Well, 2026 has been off to quite a start for the broader markets, but when it comes to the Fed outlook, where do you stand right now?
So I think there's a couple things that are going on with regard to the Fed. One is there's this uncertainty about Chairman Powell, his departure that's coming in the next few months, what that implications will mean for the next chairman of the Fed, and what the policy path could be from there. But the reality underlying the economy is that things are okay. Not great, but okay. And the result is that the Fed has now been a bit less focused on the inflation posture, which had been a concern for a number of years post-COVID, and a bit more focused on employment, or lack thereof. We've had very little growth in the employment picture for the U.S. in the second half of 25. We came into 26 with some statements, even from Chairman Powell, that even some of the numbers may have actually been overstating the amount of jobs that were created during 25. And the Fed has been a bit more focused on that leg of this stool. And in our mind, that means the Fed needs to cut more. We need to get to that neutral policy rate, something closer to 3%, 275, something in that neighborhood, that would allow the Fed to be able to reset, see how the economy unfolds, is inflation truly beaten, or are there some risks around tariffs, and then evaluate the picture going forward.
Yeah, and speaking of which, the picture going forward, I know you're keeping a close eye on the macro dynamics, and of course we're all watching that jobs report coming out on Friday morning. But when it comes to the macro outlook for 2026, give us an idea of what you're watching and why.
So there certainly was a slowing in growth during 25. Yeah. Not to a recessionary level, not something that you would sit down and say, oh my goodness, there's something bad going to happen, but a slowdown in growth. You saw it in ISM yesterday, you've seen it in some of the survey data, which would suggest some consumers are really comfortable and happy and some aren't. And so that's a recipe in our mind for maybe slightly below trend growth in 2026, but so much of it is going to depend on what are the implications of tariffs? How does that play out in terms of prices? Do we see geopolitical risks? We had Venezuela this weekend. We're still dealing with Ukraine. How do some of the uncertainties around Asia with China and Taiwan, and how does that really play out in terms of the confidence of the consumer in 2026? But the underlying trend remains one of okay growth, and one that would be suggestive of that there's not a cliff that we're about to go over in terms of the economy.
And speaking of which, you just highlighted the fact that there's so many moving parts when we look at the macro factors heading into this year. But I do want to shift our focus on over to bonds, in particular high yield as well as investment grade. So give us an idea of what you're paying attention to.
So I think there's two different elements to thinking about investing in the credit markets. One is the underlying health of the companies, and that that plays out in equities, that plays out in corporate credit, even some securitized assets. So if you start to think about, are these companies in a good fiscal position? Are they able to sustain their debt burden? What is their earnings profile on a go-forward basis? And all those things are actually pretty good right now, Remy. You look at the health of these companies, they're better than they've been in the last decade. The second part is the valuations. The markets are rewarding them with tighter spreads. And so as we think about it from an investment perspective, yes, spreads are tight, but the quality is justifying that tighter level of spreads. The one area where we're a little bit more focused is municipal bonds. If you start to think about what happened during 25, there was uncertainty about whether or not you were going to continue to be able to enjoy the tax-free income associated with municipal bonds. Geopolitical risks still remain potentially, but we're really at the forefront during 2025 in the first year of the second Trump administration. But that seems to have settled down a bit. And now what you're seeing is that municipal bonds have very attractive tax advantaged income associated with them, and the yield curve is much steeper, i.e. you get a lot more yield out of longer term municipals than you do in credit. So it's an area that I think some investors think about just purely because of the tax advantage nature, but even seeing some taxable investors look at it as an attractive place to park money.
Yeah, and while we're talking about other markets as well as geopolitics, how should investors who are looking at emerging markets, how should they be looking at debt?
So emerging markets is often grouped together, and we think of it as, okay, this is one thing. It's really not a thing. It's a collection of idiosyncratic risks. You have obviously issues right now with Venezuela and the rest of South America and the uncertainty surrounding that, and contrast that with Asia or Eastern Europe, where there's much more stability than what you're seeing with regard to Ukraine or Venezuela. So, emerging markets was the best performing fixed income asset class during 2025. You had their currencies appreciating, you had their debt continue to do better, as they tend to do better when you have improving commodities and you have stable and good growth with lower inflation. Lower interest rates also help many of these emerging economies because they have their very heavy debt burdens. So we think it's a great place to look for opportunities in 2026 and beyond, but not think about it as an asset class, but think about it in a total return setting. Rather than just saying, I'm going to buy emerging market debt, think about buying a product that has a much more aggressive, total return oriented process.
Okay, Michael, well, we will have to leave it there for today, but thank you so much for joining me, and Happy New Year.
Happy New Year.
Thank you.